now we're going to talk about the process. How do you put this all together? And I have the wrong slide up, so bear with me while I get there. Right here. So we're talking about how to calculate free cash flow from a project. So you need three components. You need the initial outlay right here. You need the differential flows over the product's life, and this means year 1, 2, 3. How does it flow in? How many years out? How many years in? And then the terminal cash flow, which is the cash flow at the end. So let's kind of look at each one of these. I'm not going to give you an example of this. I would like for you to go to page 530 or 350 in the book and review how they have it set up. It is a beautiful setup in the book. They do it twice so that you can go through it 2 times and you'll have a really good feel for the steps you need to take to set this up. So your initial cash flow is the initial outlay is the immediate cash they're going to need to purchase this, whatever it is, the asset or put a process in place or develop a product. So you need to look at a purchase cost, a setup cost, the installation, the shipping, increased working capital requirements, sale of existing assets, and tax implications, all kinds of things you need to look at even before you start the project. How much is this going to cost you initially? That's your initial cash outlay. Then you start looking at cash flows that are going to come back to the firm for doing this project. So you'll look at the cash flows from operations. You'll look at cash flows from the working capital requirements, which means before the project, you'll have the numbers, and then after the project is implemented, what are those numbers? So you compare back and forth. And then you have cash flows from capital spending throughout the project. So now, then, finally, you're going to calculate it, and these are the steps. So step 1, you measure the project's change in after-tax operating cash flows. And that is operating cash flows equal changes in EBT, earnings before interest and taxes. And you're going to subtract the change in taxes, and you're going to add back the depreciation. Sounds an awful lot like a cash flow statement, doesn't it? Depreciation is a non-cash expense, so it's got to be added back in. It has nothing to do with cash. Step 2 is then you're going to look at the terminal cash flows that are associated with termination of that project. Okay, and that may be, the salvage value or any tax gain loss of the sale of an item. So what you're going to end up with is something like this. Okay, here's calculating the annual change in earnings before taxes and interest. So you're selling 100,000 units, you've got $600,000. Here's your variable cost you take out. Then you take out your fixed. This gives you income before interest, taxes, depreciation, and other taxes, or amortization. And you have that. So this equals your earnings before interest and taxes with $160,000. Take out your taxes, so you have a net income, which is you're looking at for your cash flow, I believe, of $105,000. Now you're looking at earnings before tax minus the tax plus the depreciation now. So that gives you $155,600 in operating cash flow. And then you're calculating the free cash flow. So you've got 160, you've got taxes, you've got you've added the depreciation, and now you've looked at the net working capital. Your working capital, did it go up or down? So now, what have we got? We've got a free cash flow of $185,000. See all the steps you went through? First you found EBIT, then you came back and you looked at it and you added depreciation, then you came back and looked at it again and looked at the working capital. So that gives you a year's worth of cash flow. Then the next thing you look at is options and capital budgeting. You've got a number, you've got the cash flow, so what are my options? Do I just reject it? Well, you don't necessarily, you can say, I'm not going to do it right now. Maybe I'll delay it, because maybe in 5 years it will be more feasible, maybe in 5 years conditions will change. I'll just table it for now. Or I could expand it. I could say, okay, this has a good cash flow, but what if? So I could expand the project and then do another evaluation. Or the other option would be I could just simply abandon the project. I could start it and find out that maybe 3 years down the road, we projected 5 years, and 3 years down the road the conditions had changed and we could abandon the project. So you have options after you do all of the evaluation and come up with this number. This is your cash flow, free cash flow. This may be for 1 year, it may be for 2 years, just depending on the length of your project. But there are always options to go to after doing this analysis. So this was a very short overview of what you have to do those free cash flow calculations. Again, it's the initial outlay, right? It's the flow over the cash, the life of the project, and then you look at the end of the project and if there's cash involved there of selling items or closing it down. And again, go to page 350 in the book and it will give you an excellent example of how all of these numbers came to be. It has an income statement, a comparable income statement, and it basically takes you step by step through this. This is a very good thing to understand, so study it well. Thank you.